What the chart doesn't show is the emotional toll of watching your first investment portfolio go red during a downturn, the panic selling at a loss, and the years of learned risk aversion that follow. Because behavioral risk is real too. People who invest before they're financially stable often don't become confident long-term investors. They become people who had a bad experience and stopped. The compound interest chart assumes you never touch the money. It assumes the market cooperates with your timeline. It assumes your life does too. Life tends not to ask permission. There's a structural reason this narrative persists. The financial industry makes money when you invest, not when you build an emergency fund, not when you pay off debt, not when you spend a year building financial stability before putting anything in the market. The apps, the funds, the advisors, they are optimized for assets under management. Every dollar sitting in a savings account is a dollar they are not earning fees on. That doesn't make investing bad. It makes the incentives worth understanding. The most financially successful people tend to follow a very unsexy sequence. First, stability. Cash reserves, no corrosive debt, insured against catastrophe. Then, once the downside is protected, invest aggressively for as long as possible. It's not as exciting as starting at 22, but it works. Consistently. Quietly. Without requiring you to sell at the worst possible moment. Priya eventually rebuilt. She spent 18 months clearing debt and building reserves. Then she invested. Steadily. Without ever being forced to sell. Today, her portfolio is intact. But here's what I keep thinking about. All the people who got the same advice she did, start early, time in the market, compound interest, how many of them actually had better outcomes? And how many of them are just not talking about it?
So here's the question nobody wants to ask. What actually has to be true before investing early makes sense? First, you need an emergency fund. Not a preference, a requirement. 3 to 6 months of actual living expenses. Rent, food, utilities, transport. Sitting in cash. Not invested. Not in a money market fund. Cash. Because an emergency won't wait for a favorable market window. Second, you need to have no high interest debt. The average credit card in the United States carries an interest rate above 20%. The average stock market annual return, historically, is around 10%. Paying down a 22% APR card is the equivalent of a guaranteed 22% return. There is no index fund on earth that can compete with that on a risk-adjusted basis. Third, and this is the one that really stings, your income needs to be stable enough that you can leave the investment alone. Not somewhat stable. Stable enough to weather a job loss, a health issue, a car, a roof, a relationship ending. Whatever life decides to schedule during a bear market. Most 22-year-olds don't have all three of those things. A lot of 35-year-olds don't either. But the financial content machine doesn't want to say that. Because make sure you have a fully funded emergency fund and are debt-free before investing doesn't get clicks. It doesn't sell apps. It doesn't grow a newsletter. Your money could be working for you right now. Does. The compound interest charts you see are real. A $5,000 investment at age 22 growing at 8% annually.
All of that is true. But there is a layer underneath that nobody shows you. A cost that doesn't show up in any compound interest calculator. A risk that gets buried under charts of exponential growth. And once you see it, you cannot unsee it. Let's talk about what investing actually requires. Not in theory, in practice. When you put money into a brokerage account, into index funds, ETFs, individual stocks, that money is now illiquid. Not locked in a vault. Technically you can sell. But here's the thing. Selling at the wrong time doesn't just break even. It can permanently destroy the value of what you built. Markets go down. That's not pessimism. That's history. The S&P 500 has had peak-to-trough drawdowns of 34% in 2020, 57% in 2008, 49% in 2000. If you need money during one of those windows, and life has a way of making you need money, you are selling at the worst possible moment. Now here's the math that gets hidden. Say you invest $10,000 and your portfolio drops 30%. Not unusual. You're now at $7,000. For that investment to simply return to $10,000, you don't need a 30% gain. You need a 43% gain. That asymmetry between losses and the gains required to recover them is one of the most important and least discussed concepts in personal finance. And it gets worse. If you're forced to sell during a downturn to cover an emergency, you don't just lock in that loss. You also eliminate all future compounding on that capital. The $10,000 that became $7,000 that you sold, that money could have been $40,000 in 15 years. You didn't just lose $3,000. You lost everything it would have become. This is what behavioral economists call a sequence of returns risk. And it doesn't only affect retirees drawing down their portfolios. It affects anyone who invests money they might need.
The hidden cost of investing too early. Everyone told Priya to invest early. She was 24, she had a stable job, she had $8,000 saved up. And everywhere she looked, TikTok, Reddit, her older cousin at Thanksgiving, the message was the same. Time in the market beats timing the market. So she invested. All of it. And then, 4 months later, her transmission failed. 2 months after that, she had a medical bill. And then her lease ended, and she needed first, last, and security. She had to sell her investments at a loss. Every single dollar. Here's what nobody told Priya, and what almost no financial influencer will say out loud. Investing too early might be one of the most expensive financial mistakes you can make. We are living through the golden age of the investing pitch. Brokerage apps are free, fractional shares exist, you can buy a piece of the S&P 500 with $1. And the entire apparatus of financial media, the YouTube channels, the podcasts, the books with orange covers, is built on one foundational premise. Start investing. Now. Immediately. Yesterday. The logic sounds airtight. Compound interest is real. Time does amplify returns. $1 invested at 25 is worth more